You were looking at a crime scene, not a market correction, not a panic sell-off, a crime scene. For the last 3 days, I've been analyzing data that defies every law of financial gravity, data that suggests the 39% collapse in silver was not just predictable, but mathematically engineered. While the headlines are screaming about retail investors losing trillions, they're ignoring the single most important signal in the noise, a signal that proves the smart money did not panic. In fact, they were waiting for it. Here is the anomaly that should keep you awake at night. Historically, silver miners act as a leveraged play on the metal itself. It is a decades-old correlation. If silver drops 10%, the mining stocks, the companies digging the metal out of the ground, typically drop 20%. It is simple beta. But on Friday, when silver suffered its most violent single-day drop in modern history, crashing 39%, the miners did not follow the script. By all historical metrics, they should have been annihilated. They should have dropped 60, 70, perhaps 80%. But they didn't. They fell only 22%. Why would the companies whose entire existence depends on the price of silver hold their value while the metal itself collapsed? There is only one explanation. The institutions holding those stocks, the hedge funds, the family offices, the insiders knew the crash was artificial. They didn't sell because they knew the crash was artificial. They didn't sell because they knew the price action was a lie. They watched the paper market burn, and they sat on their hands. They knew this was a shakeout, not a sell-off. And to understand why, we have to look at the evidence that proves this was a setup from the very beginning. To execute a heist of this magnitude, you need a distraction. You need a narrative that forces the herd to run off the cliff. This trap was set over a perfect 72-hour window. It began on Tuesday with a signal for a wheat dollar policy, the ultimate green light for precious metals. Billions of dollars in hedge fund and retail capital poured into long positions, chasing the momentum. By Thursday night, euphoria had set in. Silver hit all-time highs. The trap was full. Then the steel jaws snapped shut. Before markets opened Friday, the narrative flipped 180 degrees with the announcement of a dollar hawk Fed chairman. This wasn't just bad luck. It was a forced liquidation event. The same traders who were lured in on Tuesday were forced to vomit their positions on Friday. But while retail traders were being margin called, a specific group of players was waiting in the shadows. We know who they are, not because of conspiracy theories, but because of court records. We are talking about institutions that have been criminally convicted, not accused, convicted of rigging these exact markets. Let's talk about spoofing. It is a technique where massive fake orders are placed to trick other algorithms and traders into panicking. It is fraud. It is illegal. And for over a decade, the world's largest banks ran it as a standard business practice. JP Morgan, HSBC, Deutsche Bank, Scotiabank, they have all paid hundreds of millions in fines. Their traders have gone to federal prison for racketeering charges, usually reserved for the mafia. And yet, these banks are still the primary market makers. They paid the fines, which amounted to a rounding error on their balance sheets, and went right back to work. Do you honestly believe a billion-dollar fine stops a trillion-dollar racket? The events of Friday suggest the playbook hasn't changed. It has just become more sophisticated. The most damning piece of evidence comes from a document most investors do not even know exists, the COMEX delivery report. This isn't a blog post. It is the official ledger of the CME group. It records who stopped or closed their contracts and at what time. When we examine the ledger for the day of a crash, we see something spectacular. JP Morgan Securities closed 147 short contracts. But they didn't close them when the price was high on Thursday. They didn't close them halfway down. They closed them at the absolute bottom of the crash. The timing was surgical. The entity that had the most to gain from a price collapse managed to exit their short positions at the exact moment of maximum profit. They were not alone. Morgan Stanley and Deutsche Bank, HSBC, the same syndicate of banks previously convicted of manipulation, all appear on the ledger, closing positions at the bottom. This is the smoking gun. While retail investors were being liquidated, the architects of the crash were cashing out. They transferred wealth from your account to theirs in a matter of hours. This explains why the mining stocks didn't crash. The big money knew the banks were just clearing the deck. They knew the drop was a temporary mechanism to cover short positions, not a fundamental shift in value. But the manipulation didn't stop with the banks. The exchange itself, the CME, played a critical role. In a fair market, exchanges raise margin requirements, the cash you need to hold a position when prices are rising too fast, to cool things down. That is risk management. But that is not what happened here. The CME raised margins after the crash. Then they raised them again the next morning, and then they announced a third hike for the following week. This sequence is devastating. By raising margins after a 39% drop, they ensure that anyone who survived the initial crash is forced to sell anyway. They are not protecting the market, they are executing the survivors. It is a double tap. This aggressive, unprecedented hiking of margins suggests something terrifying is happening behind the scenes. A major player is insolvent. You do not panic hike margins 36% overnight unless the clearinghouse itself is at risk. Someone is underwater and the system is scrambling to contain the blast radius. We've seen this movie before. In 1980, when the Hunt brothers cornered silver, the rules were changed overnight to crush the price. In 2011, margins were hiked 5 times in 9 days to break the rally. And now, in 2026, we see the exact same pattern. Every time the public starts winning in precious metals, the casino changes the rules. They crash the paper price to protect the fiat currency system. It is a policy of containment. However, there is one thing they cannot manipulate: the physical metal. The paper market is a digital illusion, a game of contracts and leverage. The physical market is reality, and reality is breaking. This weekend, Golden State Mint, one of the largest private mints in America, suspended sales. Their official statement: they could not secure silver. Let that sink in. The paper price says silver is worthless, yet the physical suppliers cannot find enough metal to sell. This is the ultimate divergence. We are witnessing a complete decoupling of price and value. If silver was truly worth $75, the world would be awash in it. Instead, dealers are sold out, premiums are 100% over spot, and mints are closing their doors. The paper market is screaming sell, while the physical market is screaming shortage. This happened during the 2008 financial crisis. It happened during the 2020 pandemic panic. And it is happening now. The shortage is real. Solar panels, electric vehicles, advanced electronics, they all require physical silver, not paper contracts. Industrial demand hasn't vanished because of a red candle on a chart. The crash has merely allowed the strong hands to accumulate physical assets at a discount, while the weak hands are washed out of the paper market. The banks have covered their shorts. The leverage has been flushed. The stage is set for a violent reversal. The recovery, when it comes, will be ferocious. The same algorithms that drove the price into the abyss will be forced to chase it back up. But the next leg up won't just be about price, it will be about availability. We are moving toward a world where you might have the money to buy silver, but you won't be able to find it. The mint closures are the canary in the coal mine. So, what do you do with this information? You must understand that the volatility is the weapon. They use it to shake you out. They want you to look at your portfolio and feel fear. They want you to sell so they can buy. The evidence is irrefutable, the miners held. The banks bought the bottom, and the physical metal is disappearing. The game is rigged, but once you see the strings, you can refuse to play by their rules. This is not the end of the bull market. It is a crime scene investigation. And now that you have seen the evidence, you have a choice. Do you trust the paper price, or do you trust the physical reality? The banks have made their move. Now it is your turn.